typically coming into the year, depending on what you read, the expectations were you get two 20+% total return years in the S&P 500. That portends to typically a strong third year. It might be choppy, but it does end up typically, at least historically, being a positive year. So I think the setup was we had two really strong years in the S&P 500 coming off of that really difficult year in 2022, and the market should be green based on all of these tailwinds, deregulation and tax cuts. And then, of course, we had the tariff tantrum in April.
All right, everybody. Appreciate those that are starting to watch this episode of Lead Lag Live with Paul Baiocchi. I'm looking forward to this conversation. I had a really good conversation with Paul about a month ago talking about markets. And I think we're going to hit on some really interesting ideas and themes for the second half of the year. For those that are listening to this on podcasts, do me a favor, please share this podcast, Lead Lag Live, to others that you know. I keep getting some good momentum on these programs, and I want to make sure that that continues, obviously. And those that are going to be watching this or are watching this right now on YouTube, make sure you like and subscribe as well. With all that said, my name is Michael Gaia, publisher of the Lead Lag Report. Joining me here is Paul Baiocchi of SS&C ALPS. They are a client of mine, so this is a sponsor conversation, but believe me, you want to hear what Paul's got to say. So Paul, we're past the halfway mark. I saw some posts on X. It's like we are closer to 2030 than we are to 2020. Which made me feel a little nervous, right, in terms of where we are in the decade calendar. But we've just gone through the first half of the year. I want to just get your thoughts on what's happened the last 6 months, and then we'll talk about what's going to go on the next 6 months from your point of view.
Did something happen?
Yeah, there was all that. I kind of vaguely remember some things, but, you know.
Stocks go up. Yeah, it's interesting because the first half of the year was such a ride. And then you look up at the end of the first half of the year and the S&P 500's up 5+%. You got a number of key leadership sectors in the S&P 500 up meaningfully for the year. Leadership from cyclical sectors in the market, industrials, communication services. And so if you were to just sort of black out that, let's call it March to early May period, and then just look at what happened in the market over the course of the first 6 months, you might feel like, hey, this was just business as usual, a continuation of a bull market. And typically coming into the year, depending on what you read, the expectations were you get two 20+% total return years in the S&P 500. That portends to typically a strong third year. It might be choppy, but it does end up typically, at least historically, being a positive year. So I think the setup was we had two really strong years in the S&P 500 coming off of that really difficult year in 2022, and the market should be green based on all of these tailwinds, deregulation and tax cuts. And then, of course, we had the tariff tantrum in April. And I think you can unpack the early part of the year in a number of ways. So first of all, you had this meaningful outperformance of EFA relative to the United States. And that has held up pretty well. You've got EFA up north of 17% year to date. You've got the S&P 500, as we mentioned, up around 5.5%, 6%. And so they built a pretty wide gap going into the tariff tantrum, both corrected pretty meaningfully. And the U.S. has been playing catch up since then in terms of the outperformance that we've seen in developed ex-U.S. And I do think coming into the year, there was a lot of headlines around U.S. exceptionalism, and you even had publications like Barron's running headlines around just how dramatic the outperformance of the U.S. was and how superior the U.S. market was to all of these other markets around the world. And at the same time, you have people talking about, well, the U.S. is trading at historically high cyclically adjusted PEs or absolute PEs, trailing or forward, and that typically portends to relatively weak performance on a go-forward basis. And so there was a lot of noise coming into the year. There was an expectation, I think, that the market would be green, but the way we've gotten here has been so fascinating to me because the developed ex-US story has awoken, and some of it has to do with the weak dollar. You had, even in that taper tantrum, people forget how painful that felt in the moment. But within the market, you have the defensive sectors sort of doing exactly what defensive sectors are supposed to do. The drawdowns in utilities and staples and healthcare was significantly smaller than the drawdowns that you saw in other sectors of the market, like technology and some of the other cyclical sectors of the market. So in some ways, it's this fascinating case study in different market components, whether they be sectors, whether they be cap buckets, or whether they be developed versus US, and of course, other capital markets dynamics, including the dollar and interest rates. And so it feels like we jammed a decade's worth of market dynamics into 6 months of the year. And yet here we are in early July with the market green and trending higher, with momentum leading the way, growth leading the way, and quality and value lagging. That, in many ways, is a continuation of what we've seen in this bull market. But at the same time, the road to get here wasn't a straight line. It was very much a winding road and filled with a lot of uncertainty, a lot of consternation, and frankly, a lot of bad predictions. If you look at what was being predicted in terms of reacceleration of inflation, haven't seen that. Job losses, haven't seen that. Economic growth deteriorating meaningfully, really haven't seen that. If you look at GDP now, it's thanks to some of that import acceleration in the early part of the year, running around 3+%. So it's a hat tip, if you will, to the people who stuck to their guns. Retail bought in earnest in the dip, which has been a meaningful influence on this market, maybe different than cycles past. And then the challenges, to be diplomatic, around forecasting markets and the economic backdrop accurately, and some of the sort of doomsday headlines that we saw.
All right, so there's a lot I want to unpack there. Let's talk about the EFA outperformance. You often hear that, well, the reason foreign stocks are doing so well is because the dollar is weak. How much of that is the explanatory variable?
I do think that is a large driver of the outperformance that we've seen. And I don't think that the dynamics for the dollar weakening are the typical dynamics you think about. So typically, currency pairs trade based on rate differentials. That's the most important thing people typically look at. In the United States, relative to Europe and relative to other developed markets, has been pretty tight, right? We've only had a couple rate cuts in this easing cycle. Europe's had multiple rate cuts. And that rate differential is actually in the United States' favor, which you would think would portend to a strong dollar. But what's undermined the dollar, or the Dixie, the basket of currencies that the dollar is typically measured against, is central banks moving from dollars to gold or to other currencies. That's been one pressure point on the dollar. The other one is investors in foreign markets hedging out their dollar risk in their dollar-based investments. And those two things naturally put downward pressure on the dollar. And so in theory, if you get easing from the Fed, and the market's pricing about 2.1 cuts here in 2025 in the remainder of the year, we were at 2.7 not long ago before that higher than expected jobs print, then you might see additional pressure on the dollar, because then all of a sudden the rate differential starts to go in the opposite direction. And in theory, that would put additional downward pressure on the dollar. So I think it has to do with the dollar, but you've also seen some dynamics at work with EFA that have made that rotation a little bit more compelling than it's been in the past. We've seen this alligator chart of valuations on the US market versus EFA, which has started to close a little bit. Those alligator charts tend to close, mean revert. And then you've also seen some pretty compelling earnings growth in some of the key companies in the EFA index and in the broader developed ex-US world. So you've got that valuation story, you've got that relative earnings growth story. And then on the capital market side, you've also got a relative easing posture from the ECB and many of the central banks in the developed ex-US marketplace. You've also got a fiscal stimulus in place in countries like Germany with their defense spending, as well as some of these NATO countries agreeing to increase their spending on defense as part of that NATO agreement. And so the fiscal impulse in developed ex-US is more accommodative than it had been, combined with an easier monetary posture. And that, on a relative basis, has been a pretty nice setup for developed ex-US. And we've seen good flows into IDOG, our developed ex-US ETF focused on the EFA marketplace. And part of it is because it's a dividend-oriented strategy with a little bit more sector balance than you get in an EFA-based index methodology, but also, I think, importantly, because it's a more value-oriented look at IFA. And in a value market, taking an even more significant value orientation has been a compelling way to play that story.
So value is an interesting thing to talk about. And I'll even relate it to your point about there was a lot of noise. And you mentioned in the first part of this, deregulation is a tailwind, which is something that I'm a big believer in, right? And it seems like Trump is pretty serious on that end. I wonder if there's an argument to be made that deregulation is what brings back value relative to growth. Because if we look at the sector composition, a lot of the value tilted indices, what are the sectors? Financials, industrials, energy. I mean, those are
some materials in there.
Some materials in there, right? So, and obviously financials and energy have the most sort of regulatory burden, you can argue, right? Yeah. So is there an argument made, do you think, that deregulation, because it could impact those sectors maybe disproportionately, that's really sort of the real catalyst now for value to outperform growth?
Yeah, I mean, in some ways, like developed ex-US, and you could extend that to small caps and now to value, it feels like the story for value is akin to the boy who cried wolf, because we've been hearing for the past 5 years, this is a time for value, this is a time for value. We heard in the prior decade that value doesn't work in a ZERP environment, and so that's the reason that growth's been outperforming value for so long, and we've seen a couple head fakes with value. And so I would agree, just based on your typical makeup of a value-oriented strategy, there does tend to be sector orientation there that in theory would benefit from deregulation, but we've been looking for catalysts for a value rotation for half a decade or more, and they just haven't played out in a meaningful way. We've had head fakes. If you go back to 2020 and into 2021, maybe even into 2022, you did see some strong relative performance of value in periods, but we haven't seen a durable relative performance period for value. And I think it probably makes value managers crazy, because no matter what they do or how good they do their job, they still end up lagging their growth counterparts. And I find it hard to believe that we're never going to see value outperform again, because what market history tells us is that these cycles do tend to play out over long periods of time. And the fact that we've gone as long as we have with value underperforming should set up for value to be a relatively attractive factor. But again, what has been rewarded in this market cycle? It's high quality companies. I mean, quality's lagging as a factor so far here in 2025, especially in the rally off of the April 8th, April 9th bottom. But if you look at the S&P 500, the key companies in that index that have driven so much of the total return profile of the S&P 500 are quality companies. They don't have a lot of debt. They generate a ton of ROE or ROA or ROIC, and their free cash flow generation is tremendous. And so if you think about value as a factor, it doesn't have a lot of overlap with those quality characteristics. They tend to have lower ROE in the sectors that a value strategy tends to capture. It does have a lot of leverage on a relative basis to growth counterparts. And so I think if the market has an internal rotation away from rewarding lower leverage, higher ROA, ROE, ROIC companies toward companies that might have more leverage and lower return on assets, but the valuation dispersion of those companies starts to get rewarded, then you could see a meaningful period of durable outperformance of value. And if deregulation is one of the catalysts, then I think it's going to be part of the mix of the soup, if you will.
You can argue that there was definitely a lot of noise, to your point, in the first half. Let's talk about signal. What kind of signals do you like to look at that you'd say, you know what, this is going to change my more optimistic view or maybe pessimistic view on what comes next?
Yeah, so with developed ex-US, I think the dollar is an important signal, especially emerging markets. So if you look at emerging markets, the dollar is critical to those companies in those countries, because a lot of their debt is dollar-based, and the influence of the status of the dollar relative to the basket that's measured against the Dixie tends to be a really important signal. So if you're looking for anything to determine the forward path of returns in developed ex-US, and emerging markets, I would say focusing on the dollar is a great starting point. Of course, then you have to get down to fundamentals and relative valuations to layer in or build a mosaic of a framework for determining what your appropriate allocation is to those markets within an asset allocation. Now, other signals that I think are important is fixed income and fixed income, not just in terms of the absolute level of the 10-year, but the results of auctions and the shape of the curve. Because if you look right now, when you get from, say, the next few months to, let's call it a year, maybe 4 years out to 30 years, that part of the curve is operating in a normal way. It's this near-term focus in the yield curve that's inverted. So you got short-term rates that are higher than medium-term or near-term rates. And some of that is a signal to the market that they want the Fed to cut, and the Fed has sort of dug in its heels. And part of that is the headlines that we've seen where the president's attacking the Fed chair. And now we've got this whispers about a shadow Fed chair and then who they're going to appoint and what that appointment's going to look like and what they're looking for, which seems to be, above all else, someone who's willing and able to cut. Now, the shape of the yield curve is important, not just because it signals the profitability profile of key companies in the financial sector, those regional banks that have been such a drag on the small cap index as it's lagged coming out of that bottom and over the course of this cycle, but it's also important because it gives a predictability to companies who are out in the market borrowing, the companies who do have more leverage and can pick and choose among the various components of the yield curve at which rates to borrow and which durations to borrow at. And so I would say a combination of the dollar and a combination of the yield curve and interest rates by and large are critical signals. And then as you're thinking about broader equity markets, I think important signals are the direction of fiscal, which right now seems to be pretty easy, the direction of monetary, which again seems to be stuck in neutral, but at the very least trending in the back half of the year toward easing, both of which should be supportive of corporate earnings, margins, and the outlook for both.
Let's get into the fun part of the conversation. Let's talk about ideas that you think will work in the second half of the year. I tend to be contrarian myself. I myself very much believe that we're on the cusp of a big cycle for small caps. I've been very loud about that, especially more recently. And part of that is also related to the deregulation theme, since deregulation should benefit mid and small cap companies disproportionately more than large caps for a lot of reasons. But let's talk about some of the kind of broader macro themes that you think people are not paying attention to that could be real winners in the next 6 months.
Yeah, and in some ways, it feels easy to say, well, just buy the large cap technology companies pulled from communication services and consumer discretionary in the technology sector as defined by GICS, because that's what's worked. Those are the companies that are generating the most profitability, have the highest ROE, and are of the highest quality, and just let the market bring those returns to you. But the reality is if you're a student of the markets and you look at history is not necessarily a guide. It certainly gives you some perspective on what's happened. And the old adage is history doesn't repeat itself, but it often rhymes. And that's the sort of basis for how we think about the back half of the year. And if you're trying to pull themes together because the first half was so noisy, it can be somewhat challenging. But one of the key things to me that's happened off of that April 8th, April 9th bottom is just how significantly small caps have lagged. I mean, you touched on it a little bit, but if you go through this cycle of this bull market and how poorly small caps have done on a relative basis to large caps, that stands out to me because the valuation spread between large and small isn't typically this wide. In fact, you have to go back to the dot-com era, speaking of the calendar and what the implications are. We're 25 years into this new millennium, and you have to go back that far to see a valuation spread between large and small that's as wide as it is right now. And those types of valuation spreads tend to mean revert. Now, again, it's important to apply nuance to any of this because the reality is part of the reason that small caps have suffered so much in the cycle is because higher interest rates and a tightening Fed is much more punishing for smaller companies. They have more leverage. 35% of Russell 2000 leverage or so is floating rate. And so they're much more sensitive to increases in the funding environment. And they don't have the type of leverage to go out and borrow at the rates that their large cap counterparts can. And then when you layer on the fact that many of those companies just aren't profitable, in fact, as much as 40% of the Russell 2000 is unprofitable, that is a very difficult setup for small cap companies. So you can make a case for why Russell 2000 and companies within it have lagged their large cap counterparts so significantly, and why the valuations haven't converged more than they have. But that doesn't mean that you have to throw the baby out with the bathwater in terms of small caps. You can take a pretty simple filter to a small cap universe and cull it down to a universe of companies that do generate profits, that don't have a lot of leverage, that pay a dividend and grow a dividend. OUSM does that. That's the methodology. It screens for high ROA, low net debt to EBITDA, 5-year dividend growth, dividend coverage, and there's a low vol screen in there. And so you can be in that universe with a shallower drawdown profile, a better risk reward profile, and insulate yourself from some of the vicious drawdowns that you get in the Russell 2000. Because even though the Russell 2000 has lagged pretty considerably over this cycle, a lot of that just stems from the fact that the drawdowns in the Russell 2000 have been so violent. And you know, Michael, the math of making up lost grounds off the back of a significant drawdown in the market is a very difficult proposition. And the Russell 2000 had 4 drawdowns of 8% last year alone. And so just ratcheting down your risk and improving the quality profile of your small cap orientation can ensure that the ride might not be as bumpy. And although it may lag your large cap counterparts, at least you're going to participate in what could be a meaningful cycle for small caps. And that's how we're approaching it. That's how we're thinking about it in the back half of the year. You've seen outflows from some pretty meaty small cap oriented ETFs in the first half of the year. And again, it feels like that developed ex-US story or the value story where it's been a sore thumb in client portfolios. It's like the boy who cried wolf. But at some point in time, what we know is that historically, the small cap factor is important. It's additive. It's a diversifier. And you talk about deregulation, you talk about reshoring, you talk about even a falling dollar. Small caps are a little bit insulated relative to large caps from some of those dynamics because deregulation in theory should be beneficial to smaller companies. A dollar volatility profile is less impactful on the revenue stream of small caps because they famously have less foreign-based revenues relative to S&P 500 companies. And so you can certainly put it all together, the mosaic of a case for small caps, and see it. The question is whether or not it's going to play out. And that's what makes the market so fascinating because it's going to play out one way or the other.
I mean, at some point, small caps, they get more efficient because they have to, right? It's like if the concerns are on higher for longer and they're levered and all this stuff, okay, well, after so many years, you would think that some of these companies now have responded enough to that where the market should start to anticipate that now they have a better likely go forward return profile.
Yeah. And I think for better or for worse, people view small caps as the undergrads of S&P 500, meaning they're going to graduate one day. They're going to get big enough to be in the mid cap and then big enough to be in the large cap. And that is true. There are companies that were once upon a time Russell 2000 companies that went public, grew into a larger market cap, and eventually made their way into the S&P 500. Famously, there's a number of companies there. But there are also a number of companies in that universe that are just solid companies. They generate profits. They don't have a lot of leverage. They have a strong brand, but maybe the total addressable market isn't as big as it might be for a large cap company operating in other pockets of the economy. And so if you can distill that universe down to those companies, that might even include some companies who will eventually be S&P 500 companies, that to me is a logical way to allocate to the category as opposed to just saying, you know what, I'm going to buy large cap, or I'm going to buy small caps, and I'm just going to put up with this 40% or so of the companies that don't make money because the benefits of having the companies that are going to graduate is going to overwhelm the drag that those zombie companies, if you will, pull down on the portfolio.
Separate from the cap side and the style tilt side, let's talk about the theme side for a bit. I know, obviously, you've got a big focus on the electrification angle. I know you've got a fund on that. Let's talk about that, and let's talk about where things are on electrification.
Yeah, so ELFI, ELFY is the ticker. It's an electrification infrastructure ETF. It's designed to invest in the companies that are going to benefit from the electrification theme, not the companies that are going to drive the electrification theme. So if you think about it, we've got these Mag 7 companies spending upwards of, let's call it 300 billion in CapEx to build out their AI capabilities, whether it's data center investments, chip investments, whatever's needed to ensure that they can go and pursue their AI strategy. Well, those are the drivers of electricity growth as it relates to AI electricity demand growth. The companies that are on the other side of the table, who are providing the electricity, who are building the data centers, who are providing the components, who are providing the inputs to grid enhancements and grid modernization. Those are the companies that in theory are going to benefit from the electrification theme. And I think it's important to focus on the AI data center theme because if you look at some of the estimates, you're talking about this massive hockey stick function in electricity demand growth coming specifically from AI data centers. But the reality is we're trying to get people to drive EVs as opposed to ICEs, or at least we were in the prior and previous administrations. That means, in theory, more people plugging cars into their garages and into this electric charging network that we've attempted to build nationally. That's an increase in electricity demand, all else equal. We're trying to get people to move from their typical heater or air conditioner to a heat pump. Those require more electricity. We're trying to get people to move from a gas stove to an induction stove. That, in theory, also drives up electricity demand. We're trying to reshore more manufacturing, which in theory means more electricity demand. So you've got this convergence of all of these drivers of increasing electricity demand, which leads to two things: increased electricity demand wholesale in the United States and globally, because we're not the only ones doing this, but also, importantly, the electricity intensity of economic growth is increasing, meaning for every dollar of GDP that we generate, it's going to require more electricity than it has in the past. And we haven't seen this type of growth in electricity demand since the 1960s. And so again, getting back to the idea of, well, who's going to benefit? Well, certainly some utilities companies are likely to benefit from increasing electricity demand because those are typically the companies that supply it. There's some nuance there because there's regulations at the state level. They have to go to commissions. There's a little bit of NIMBY taking place where I don't want my electricity bill to go up just because an AI data center got built down the road and they're sucking a bunch of the electricity from the local utility. And so you have to be somewhat nuanced in terms of the companies that you own to capture this. But you also, in theory, need a lot of natural gas. 43% or so of the electricity generated in this country comes from natural gas. That's likely to increase as we increase our electricity demand. So the companies that own the pipelines that move the natural gas to those utilities, so those demand pull pipelines, and then the companies that are building pipelines specifically for data centers are going to be a big part of the electrification theme. You've got the components companies. So the idea is when you talk about themes, the reality is they're called thematic because they don't fit cleanly in one sector. And they're kind of sector breakers in that way. And so in the case of ELFI, it pulls from a number of sectors: energy, technology, materials, industrials, all different companies doing different things that are tied to this electrification theme. And so the idea is it doesn't fit nicely within your typical portfolio allocation because you might have a technology ETF and a utilities ETF and a materials ETF, but the weights of the companies that are benefiting from electrification aren't as targeted as they are in a product like ELFI. ELFI also was designed to have equal weighted exposure to all of the companies in the portfolio, so you don't get these sort of large market cap overweights in the portfolio or underweights in the portfolio. All of the companies pulled from 18 different sub-industries and 5 different sectors have the same weight in the portfolio, which has a mean reverting quality to it, meaning as one company goes up and another company goes down, and then you rebalance, you sort of true up the exposure of the companies in the portfolio. And so this idea that electrification is one of the biggest themes in investing is something we believe. I mean, if you think about how this is going to play out, it's not going to play out over the next 2 or 3 years. It's going to play out over the next 10, 20, 30 years, kind of like the energy transition. And so having dedicated exposure to it in your portfolio, we think is paramount. And to put a final point on all of this, when you think about the electrification theme, and you think about how it's played out already energy infrastructure last year. So ENFR, our energy infrastructure ETF, which has 27 energy infrastructure companies that own pipelines, processing, storage facilities in the United States, was up more than 40% last year. The best performing stock in the S&P 500 last year, for the first time in more than 2 decades, was a utility company. If you look at the utility sector last year, it was one of the best performing sectors in the market, even though typically utilities provide really strong performance in years in which the market's weak, not in years in which the S&P 500 is up 25%. So in some ways, you're getting a re-rating of these companies already in the marketplace. Utilities is trading at about a 2-turn premium to its historical valuation on a forward PE basis, which in some ways is reflective of how the market is viewing the growth opportunity for a sleepy old sector like utilities, which is kind of viewed as boring and defensive. And although it held up well in that violent correction we saw around the tariff tantrum, is also now separating itself somewhat from the other defensive sectors by virtue of its mapping to this longer term trend, this mega trend, if you will, of electrification.
How should investors think about valuation there? Right? I mean, or do you not even think about evaluation? And then when we talk about the construction of that ETF, how is that done?
Yeah, so I think valuation is important at any level. It's not predictive. So I do think that valuation is important. And I don't think it's predictive over near-term periods. We've seen that play out. You look at the energy sector, it's trading at an extremely low multiple relative to the S&P 500, and yet continues to see outflows, continues to have poor relative performance. So valuation should be a starting point for your investment analysis over long periods of time. They do tend to portend the relative performance coming out of that valuation. But the reality is, with a mega trend like this, with electrification, what's important from our perspective is that you own the right types of companies in the right industries, pulled from the right sectors. And the methodology itself doesn't focus on valuation. It focuses on your minimum market cap and your minimum average daily dollar volume, so that you're building a liquid basket of companies that are established and scaled, but not necessarily looking at anything like free cash flow yield or price to earnings, because that's not the signal you're looking for when you're building a portfolio like Alfie.
I think that makes a ton of sense. What about some other themes? I mean, you've got a number of funds under the suite. Anything else that kind of stands out, you think, for the next 6 months?
Yeah, so I think somewhat akin to the electrification theme is the AI adjacency theme. And I think the electrification theme is an AI adjacency play. We've seen it with some of the recent IPO activity, famously that big data center REIT or big data center IPO earlier this year had a tough go initially and has been on an absolute tear. So we've seen people in the market, investors, allocators, institutions, looking for ways to play the knock-on effects of the AI story. And we continue to come back to the midstream space, partly because we have a couple of products there. AMLP, the largest, most liquid MLP only ETF, as well as ENFR, the more diversified, comprehensive energy infrastructure portfolio. But the reason we talk a lot about that is because not only do you need natural gas to generate the levels of electricity that we're going to be demanding in the coming years and in the coming decades, but also importantly, we've already seen headlines where an MLP is building a pipeline specifically for a data center to be hooked up to a GE Vernova gas turbine to ensure that that data center has reliable electricity. And we talked about the valuation story on energy. The reality is midstream within energy is really unique. It doesn't have the same type of volatility profile that your typical energy portfolio does. Famously, the most volatile sector in the S&P 500 historically has been energy. A lot of those companies are spread businesses based on the price of WTI or what they've hedged their selling price or their marketing price for oil at. And so in that way, it checks a couple boxes. The yields on energy infrastructure tend to be relatively strong. The fundamental profile of these companies has improved dramatically. And now a sleepy sector of energy, which is very stable, fee-based business model, very consistent, has started to be mapped to this AI story in a way that drives some growth opportunities, or at least the perception of growth opportunities. And it's been reflected in some increasing multiples in some of the C Corps in the energy infrastructure space, which have either opportunities specifically around data centers or increasingly opportunities around LNG exports, which of course are now being shipped abroad to Europe and to Asia, which in theory are going to be mapped to similar dynamics in these markets where electricity demand is going up. And in some cases driven by AI, but in other cases just driven by the overall electrification theme.
You talk to a lot of advisors. I'm curious to hear what it's like on the street, on the asset allocation side, meaning are there any certain common threads that you're hearing among advisors as far as what they're worried about, what they're investing in? Take us through that a little bit.
Yeah. So I think at the end of 2024, it felt like we were trying to have conversations about international, so developed ex-US, and it was kind of talk to the hand in the sense that it hasn't worked, won't work again. Clients asked about it every time we did it, and we've just thrown our hands up on it. And you saw it in surveys where advisors just weren't allocating at all or significantly below neutral to developed ex-US. And as the calendar turned and you started to get a weakening dollar and some of this relative performance from IFA and from developed ex-US, you started to see allocators get a little bit more comfortable allocating to developed ex-US and international markets, so either toward neutral or above neutral. So that's anecdotally something we've seen. We've also seen a lot of advisors debating whether or not to move off of their low duration fixed income strategies and to take on more duration risk because they parked client assets in either cash or cash equivalents or even low duration strategies because there's been so many head fakes in interest rates. And I think if you do get a couple cuts from the Fed here in 2025 in the back half of the year, that in theory is going to dilute the yield you get on shorter duration products and bring us back to an environment like we had in the prior decade where you're looking for other ways to generate yield. And one thing they're concerned about, some of the advisors we talk about when talking about extending duration, moving into the intermediate segment of fixed income markets, is the challenged risk reward profile of credit. So you look at junk. So look at high yield bonds. They've outperformed the ag so far in 2025. We're back to historical tights. You look at even investment grade. We're at close to historical tights. And the value proposition of being in credit and the risk of being in credit at a period when spreads are so narrow is extremely intimidating for advisors who have been seasoned and have seen these credit cycles play out historically. And so those are the fixed income conversations we're having, is moving into the intermediate space, away from the short duration space, doing so in a thoughtful, nuanced way, but also understanding that the risks below the surface in high yield and investment grade credit categories are worth monitoring. And a lot of the portfolio managers in the intermediate, core plus, or core strategies have gotten really aggressive with their MBS weights, with their investment grade weights, and even with the nature of their high yield exposures. And whether or not that comes back to bite them, of course, remains to be seen. But that's one of the concerns that advisors have, is being too aggressive in those strategies at a moment where the risk reward profile of credit markets is not where it was even, say, 4 or 5 years ago.
Yeah, and you know that I've been on that kick for a while, sort of the unusually tight credit spreads. Although who knows, maybe it's not that unusual when you consider all the shenanigans that are happening on the fiscal side. Speaking of that,
or on the private side,
or on the exact right, yes,
private credit side.
Yeah. So maybe for the last few minutes here, Paul, talk about ALPS overall, the firm in terms of what it does beyond the funds, and where people can learn more about the products.
Yeah, so alpsfunds.com is the website where you can go learn about all of our ETFs, all of our mutual funds, and all of the services we provide. If you're an institutional investor or an advisor, we've got an ALPS advisor site where you can go and get additional research and perspectives from our multi-asset research team. SS&C, our parent company, is a financial technology company, publicly listed, S&P 500 company, but most of their business lines are in financial technology services. Black Diamond is a property a lot of advisors are familiar with because they either use it or they use competitors. And we've been building over the course of the past 4 years an environment in Black Diamond to unlock a lot of efficiency for advisors, whether that's outsourced CIO capabilities, a turnkey asset management platform, a model marketplace, tax-aware investment strategies, and proposal generation tools that are designed to make an advisor's life easier. And so in some ways, I sit on the side of the business that is just tasked with trying to put our brand, ALPS, in front of as many people, as many investors as possible with our ETF lineup and make a case for our ETFs and the categories in which they compete. But the broader SS&C ecosystem and even the broader SS&C ALPS ecosystem extends to engage advisors around things like donor advised funds and turnkey asset management platforms, as well as model portfolios that in theory allow them to focus on the bread and butter of their day-to-day advisory practice, which is often servicing their clients above and beyond simply the investment management capabilities, which extends to things like planning, taxes, and in some cases, concierge services.
Folks, Paul is the man, if you haven't noticed. So make sure you learn more about ALPS, check out the various funds. I'm a big fan of the electrification angle and value and small. So he and I are very much aligned in thinking there. So it'd be nice to see that tailwind, because it's a lot easier to beat the S&P 500 when it's not just about the S&P 500. And S&P 500 right now is just a pure momentum growth, large cap US play. Let's get some broadening out. I think it'll be a good thing. As everybody's still playing the stuff that worked before, you have to think about what's going to work going forward. So a lot of really great perspective here. Thank you everybody for watching and listening to this episode of Lead Lag Live, again, sponsored by ALPS. And we'll see you all on the next episode. Thank you, Paul. Appreciate it.
Thanks, Michael. Good to see you.
Cheers, everybody.